Today we're launching our last bi-monthly report for 2016 for the Irish commercial property sector after what has been another exceptionally busy year. The autumn selling season proved every bit as busy as we'd anticipated, with a large number of property assets formally offered for sale over recent months and healthy levels of activity being recorded in all occupier market sectors. In most sectors, transaction volumes were only stymied by a shortage of product to match high volumes of demand. Irish commercial property returns continue to improve in Q3, albeit at a slower pace than had been experienced in previous quarters, as we had anticipated. Rental growth continues to materialise across all sectors, with prime office, retail and industrial rents all rising further in recent months, and now at or certainly close to levels forecasted earlier in the year. An announcement by the Minister for Finance in early September regarding potential changes to the tax treatment of certain types of fund structures, which had been widely used to acquire Irish property assets and loans over recent years, took the market by surprise. This understandably created a level of uncertainty, which saw some transactions being held up until investors got clarity in the finance bill as to how that regime would specifically affect them. Office take-up in Dublin in the first 3 quarters of 2016 reached more than 1.85 million square feet, on par with the annual 10-year take-up in the capital. Several large transactions signed in the third quarter in particular. Another busy 2 months is now in prospect as office occupiers vie to get lettings signed before year-end. Several large transactions are in legals and taking a long time to conclude, but will boost take-up further when they are ultimately signed. With several requirements active and new inquiries materialising all of the time, we're confident that activity will be sustained in 2017, with the second half of the year expected to be particularly busy. We've continued to see Brexit-related queries in recent months, although we believe that any opportunities that ultimately arise due to dislocation as a result of Brexit won't be immediate. Despite speculation that Dublin doesn't have enough office stock to cater for relocations that may occur on the back of Brexit, our research actually shows that there is approximately 4 million square feet of offices currently under construction in 29 individual schemes in the city, of which 22% is currently reserved. This will add approximately 10% to the total stock of office accommodation in Dublin. A further 4.6 million square feet has a grant of planning permission and could be commenced if required. The visibility on potential delivery should therefore give comfort to potential occupiers that Dublin is more than capable of providing sufficient, high-quality office accommodation if required. There have been a number of official building launches during the autumn season, including the formal launch of Ballymore Oxley's Dublin Landing Scheme in the North Docklands and the formal launch of Kennedy Wilson's Capital Dock Scheme in the South Docks. Prime headline office rents in Dublin rose again in recent months and currently stand at €645 per square metre or €60 per square foot. Almost 1 million square feet of take-up was recorded in the Dublin industrial sector during the third quarter of 2016, reflecting a 68% uplift quarter on quarter. This was boosted by a number of large transactions that signed in Q3. Despite the volume of activity recorded in the third quarter, industrial take-up in the first 9 months of the year is still down 31% compared to the volumes of activity achieved in this sector last year. Although there are a number of transactions in final stages of negotiations at present, which should boost Q4 take-up in this sector, annual take-up for the year as a whole is still likely to be down on an annualised basis. This is reflective of a severe scarcity of modern industrial accommodation in core locations, as opposed to a weakening in demand, with several active requirements for accommodation prevailing at present. Demand from global distribution and logistics operators remains particularly strong. Some occupiers who are net exporters to the UK and as a result experiencing difficulties due to the weakness of sterling are understandably holding off making location decisions for the time being, which is affecting this sector. There has been further upward pressure on industrial rental values over recent months, with prime headline quoting rents in Dublin now where we'd predicted they would be at year-end at approximately €94 per square metre or €8.75 per square foot. Now that prime rental values are close to reaching a level that justifies new development, we expect to see an increase in planning applications being prepared and lodged for new industrial schemes. This will deliver some much needed new supply in 2017 and beyond. In the interim, we expect that occupiers will continue to opt for build-to-suit options. There has been strong appetite for industrial investment opportunities of late, which in turn has led to prime industrial yields contracting to approximately 5.5%. In the retail sector, although retail sales continue to show positive growth, there has been some nervousness in the retail sector of the economy over recent months, primarily as a result of uncertainty in the aftermath of June's unexpected Brexit vote and the subsequent devaluation of sterling. This has affected consumer sentiment to some extent and resulted in some trade leakage online and indeed to Northern Ireland. This has been particularly felt in some of the border towns and counties. The retail sector has also been negatively impacted by recent strike action, while retailers in Dublin have also had to contend with a huge amount of construction work in the city centre over recent months. Despite this, the autumn season has been particularly busy from a property perspective. Demand remains strong from a range of retailers, with several transactions being concluded in various locations around the country in recent weeks, and a significant number of transactions currently in legals and expected to conclude before year end. With strong competition for the best pitches, prime rents continue to increase, with Zone A rents on Grafton Street now at approximately €6,300 per square metre, and prime Zone A rents on Henry Street now at approximately €4,500 per square metre. Competition is particularly strong amongst food and beverage providers and retailers in the beauty sector, with several new entrants looking to open new stores in 2017. The main focus for retailers for the next 2 months will be on trading performance in the run-up to what promises to be a busy Christmas period. We expect to see a flurry of activity centred on the Black Friday and Cyber Monday sales promotions, which have become more prevalent in the Irish market over recent years. According to the latest MSCI Irish Property Index for Q3, total returns in the commercial property market increased by 2.1% in the most recent quarter, bringing the year-to-date return to 8.5%. As we had anticipated, the autumn selling season was particularly busy, with more than 600 million of Irish investment assets formally launched for sale since our last report in September. The vast majority of these extended to lot sizes of between 20 million and 50 million euro. Considering that German investor BVK have now been selected as the preferred bidder on Liffey Valley Shopping Centre in West Dublin, which had been guiding in excess of 600 million in its own right, 2016 could prove to be a very strong year in terms of investment turnover if some of these transactions complete before year end, considering that 3.18 billion had been invested in income producing investments with a value of more than 1 million in the first 9 months of 2016 alone. The likelihood is that investment spend will decline from this point forward, however, not least because of the issue which has been particularly exercising minds since the beginning of the autumn selling season, that is the unexpected announcement by the Minister for Finance on the 6th of September that his department were considering changing the tax treatment of some vehicles that had been extensively and legitimately used to purchase Irish real estate over recent years, such as quaifs and iCabs. While the unexpected announcement didn't come in October's budget, some detail was provided in the subsequent finance bill. While some categories of funds, such as pension funds, life assurance companies and other collective investment vehicles, have been specifically exempted, entities reclassified within the finance bill as IREFs, or Irish Real Estate Funds, will from the 1st of January next have to deduct a 20% withholding tax on profits distributed to non-resident investors in Irish real estate through these funds. The objective is obviously to curtail perceived tax avoidance by non-residents and to prevent certain funds avoiding paying tax on profits generated from Irish property acquisitions from 1st of January onwards. Although the new rules will affect different funds in different ways, and there are certain exemptions that investors will be able to avail of, this unexpected tax change has caused huge reputational damage for investment into Ireland and will unfortunately negatively affect the price that certain funds will pay for Irish real estate assets going forward. It remains to be seen if the pricing of, or indeed demand for, loan portfolios including Project GEM and Project Talca, which are currently on the market, will be negatively impacted by the uncertainty that these recent tax changes have now unearthed. Demand for core investment opportunities in the Irish market remains strong, however, with particularly strong demand from European buyers who are encouraged by the continued strength of occupier markets and the potential for further rental growth in some sectors. As we approach the end of what has been a very active year in the Irish investment market, prime yields remain stable across all sectors, with prime high street trending at 3.25%, prime offices trending at 4.65%, and prime industrial at 5.5%. Almost 640 million was transacted in development land sales in the Irish market in the first 3 quarters of the year, in 75 individual land sales, which suggests that the volume of land sales in 2016 is on target to match last year's bumper 770 million annual spend figure. Some recent land transactions include the sale of the Stocking portfolio for more than €39 million, the 0.35 acre Hume House redevelopment site in Ballsbridge for more than €35 million, the 2.38 acre Point Village student accommodation site at Dublin 1 for more than €20 million. Although a shortage of new housing is one of the most pressing issues facing government at present, and there is evidence of strong demand from alternative sectors, including PRS, student accommodation and nursing homes, transactional activity in the development land sector over recent months has been somewhat slower than anticipated, with very few large sites being offered for sale. Now that development plans are in operation and the government have published their housing strategy document and unveiled their well-documented first-time buyer tax rebate scheme in the recent budget, there's a sense that development activity will begin to improve, albeit from a relatively low base. In our view, the decision to focus on demand-side measures in the budget and forego supply-side measures such as a cut in the rate of VAT on new home construction was a missed opportunity, as there's no guarantee that demand-side measures focused on one small cohort of buyers will, on their own, stimulate development activity to the extent that it's required to match underlying demand. Land that is offered to the market between now and Christmas is highly unlikely to trade in 2016. The focus between now and year-end will firmly be on completing transactions on sites that are currently being marketed or where deals have already been agreed. Although there's a severe shortage of development product, we don't expect any significant land parcels to be formally offered for sale until the new year. Some developers that have used ICAF and QUAIF structures to purchase development assets in the Irish market over recent years will also now have to consider if and how recent finance bill tax changes affect their development delivery plans and indeed their exit strategies. The hotel sector of the market has continued to perform well over recent months, and this has been reflected in healthy volumes of transactional activity in the hotel property market. In total, 37 Irish hotel transactions with a combined capital value of €283 million completed in the Irish market in the first 9 months of the year. And with a number of significant transactions due to formally close before year end, the total spend for this year could well reach similar volumes to the record €710 million spent on hotels in Ireland last year. Transaction volumes would be higher again if sufficient hotel product was available, as demand for hotel properties, both in Dublin and in provincial Ireland, remains very strong, with strong demand from both Irish and international hoteliers. Considering the current shortage of hotel stock in the capital, the demand for hotel development sites in Dublin continues unabated, as evidenced by the sheer strength of demand for the 0.4 acre Zanzibar site on Ormond Quay, which was recently offered for sale and guiding €5 million. Appetite for hotel opportunities is being fueled by continuing strong performance data, with strong RevPAR growth around the country on an annualised basis. Dublin experienced a 19% increase in RevPAR in the year to date. Meanwhile, the GoPAR measure, which is gross operating profit per room, this metric increased by a phenomenal 28.1% year on year in Dublin. News that the successful Irish short-stay visa waiver programme, which allows non-EU nationals to travel from the UK to Ireland without an additional visa requirement, is to be extended for another 5 years. This has been welcomed, as has the retention of the 9% VAT rate for the hotel sector in the recent budget. Both of these initiatives are welcome against a backdrop of uncertainty as to what effect the UK's Brexit decision may ultimately have on Irish tourism volumes and Irish tourism spend over the coming years. A shortage of product is also a prevailing feature in the Dublin pub market at present, with very few pubs being offered for sale, despite considerable appetite for well-located premises in the capital. Spend has therefore been somewhat disappointing. According to our research, 23 pubs sold in Dublin during the first 9 months of the year, totalling approximately €28 million between them. A further 13 pubs totalling 22 million are currently agreed, and if these transactions close by year end, this will boost transaction volumes. In summary, the next 2 months will be particularly busy as occupiers and investors alike strive to get transactions closed between now and Christmas and bring what has been another exceptionally busy year in the Irish commercial property market to a close.